macro outlook for global economic indicators. And what will we focus on? On the first slide, the most important, one of the most important economic indicators is S&P 500 price index, the biggest stock exchange index in the world. It is S&P 500, and we have here, as you see in the chart, approximately from 1996 until today. As you see, the last update is the third quarter of, at the end of the third quarter of the 2024. Okay, so this is approximately 30 years. Here we have 30 years, and we have a chart showing the prices of the S&P index, and here some other indicators related to the S&P 500. What are those? Let's look at this. Index level. These are the numbers you see on the television, Telegram, or Twitter. Okay, these are the numbers of the price of S&P 500. And what is this PE ratio? This is forward. PE ratio meaning price earning ratio. So it is showing where is the price when I compare to the earnings of the sectors in the S&P 500. Because in S&P 500 we have companies, factories, right, firms, and they have earnings at the end of each quarter. They are reporting each quarter earning and revenue structure and balance sheet and income statement, right? And I am comparing and I am collecting all these companies in S&P 500, then I'm estimating an earning for all of this, an average, then I am converting the prices of these companies, then I'm calculating a ratio, price earning ratio. Okay, this is price earning ratio here. And the dividend yield. Dividend yield is what? Dividend yield is this. If you own, let's say, the Amazon or Microsoft, and let's say how many shareholders in the Amazon, let's say how many coupon we have, how many bonds or how many stock we have in the Amazon. Let's say it is 700 million. Okay, approximately 700 million stock we have in Amazon. And let's say Amazon price today is approximately 100, meaning that the market value for the Amazon is 700 million times 100, right? It is approximately billion or trillion dollars. Then let's say Dr. Walchin want to put approximately 50,000 for the Amazon. The Amazon overall value is approximately $1 trillion, but I want to own this company with my 50,000. Okay, then at the end of the year, let's say Amazon declared to the market, I get a revenue and profit at the end of the year, 50 billion net profit. Then they decided to distribute this $50 billion profit to the shareholders who own the Amazon. 50 billion for the overall $1 trillion. And if the Dr. Walchin has 50,000, how much money they will get from this profit? Okay, this is your dividend yield at the end of the year. From the net profit of the company, according to your shareholding percentage, you will get some portion of this earning. This will be your dividend yield. And this is the 10-year Treasury yield, risk-free asset of the United States Federal Reserve Government, the Treasury yield. And now, here in the column, you will see different dates for approximately 5 columns. It is March at the end of 2000. It is the last quarter, third quarter of 2007. It is the at the end of February of 2020 and the first day of the March of 2023 and the last third quarter, one quarter previous for this year. Why these dates are important? Do you know? Because here, except this, these days are full the crisis here. Okay, here we have dot-com crisis in the United States. Here we know the starting point of the global financial crisis. Here we have the declaration of the COVID-19 crisis. Here, the capture of the Russia to the Ukraine. Okay, invasion of the Ukraine. These are the crisis dates, and these are the dates for this. Okay, here please look at this one. Here we have, for instance, 2007. Here we have, as you see, meaning that before the crisis, as you see, before the crisis period, here, okay, the price earning is top, right? Price earning is top. Before the crisis, price earning is top. So, what message I should take from this picture? The first topic and the session and the class note today is this. If the price earning is picking up, it is time to sell. Okay, it is time to sell if the price earning picking up. Please look at here. It is last third quarter of the United States. For instance, when, by the way, I will show another S&P performance graph and you will understand what is the exact number is there. For instance, today, price earning ratio, please look at the price earning ratio here. What it was, 25 in the 2000, 15 in 2007, approximately 19 in 20, when the COVID crisis started. It is 21 when the Russia captured the Ukraine, and today it is 21. So even the index is 1,400 approximately 20 years ago, and today it is approximately 5,800, approximately 4 times higher. Okay, the 4 times is 5,600, and it is close to here. The index number quadrupled, but the price earning is lower. Price earning today is here 21, but in 2000 it is 25. So price earning is a message for us. If the price earning higher than the average of, let's say, last 20 years or last 10 years, it is time to sell. Okay, because price earning ratio higher company, meaning that I have an earning at this amount, but my price in the market is really high, and it is not reflecting my overall company performance, right? Price earning high, meaning that price is going up comparatively higher than the earnings, right? My earnings increasing 1%, but my price is increased 5%, and price earning is going up, meaning that my company earn a money, but market reflecting it is too high, and it is exaggerating in the prices, meaning that it is expensive. Please look at this slide first, and you will understand what I mean exactly. If please try to understand this historical, I will also reflect this screen here as well. Then you will understand what this price performance slide showing, price earning ratio. Here again the same number. We have 1940, 1994, and 2024, approximately 30 years we have here. In the time span, time interval is 30 years. And here, what is the multiplication of the price earning ratio? As you see here, the top in the dot-com crisis, it is 25. Okay, the highest one. And we make an interval for this price earning ratio. What is it? 30 years average. This dot green one, 30-year average is 16.73. This is 30 years average. And if I make a -1 standard deviation from this average, it is 13, and +1 standard deviation, it is not approximately 20. So +1 or -1 standard deviation from the average is a fair pricing. Okay, fair price. But above or below these prices, meaning it is really high, meaning expensive, or really low, meaning really cheap. Please look at here. In the global financial crisis of 2008, the price earning ratio approximately 10, meaning that it is exactly too cheaper for the S&P 500. Please put all your money to the S&P 500 to earn the money at the end of lifetime utility. And here, please look at after the COVID crisis. Here we have the COVID. And after the COVID crisis, now the price earning ratio around 22, 23. Meaning that even it is higher than +1 standard deviation, meaning it is really expensive. And we are here. S&P 500, when we look at the valuation metrics here, even higher than this interval. Average is here, 1 standard deviation is here, -1 standard deviation is here. But the current number even is higher than +1 standard deviation. Okay, S&P 500 today is really expensive according to valuation metrics. So let's look at here another valuation metrics. As you see here, we have lots of different calculation methodology for the S&P 500. What we mean by this? The price earning is only one approach for the valuation, whether it is expensive or fair enough to take a position in this stock exchange or not. But another one, as you see here, please look at this one, price earning ratio. Here, capital expenditure, the Schiller PE earning. Here, this one is dividend yield. This one is price to book ratio, price to cash flow ratio, and earning yield minus this is BAA yield, meaning that earning, okay, your earning yield minus the investment grade yield in the United States. BAA meaning above the investment grade. So please look at this one. Price earning here and 30-year average is here, high, so it is expensive. 30-year average for the capital expenditure, 27, and the current is 35. Expensive. Dividend yield, approximately 2%, but now it is 1.35%, meaning that if I put my money, I will get lower dividend. Not logical. Price to book ratio, average is 3.17, but the current is 4.47. Expensive. Price to cash flow just is 11 for the average, and the price to cash flow for the current one is approximately 16.50. Really high and expensive. And normally, the last one is average of the earning yield spread. This is 0.05, and it is minus now. Meaning that this is really risky compared to the investment grade yield. So in lots of different indicators, none of them saying to you that put your money in the S&P 500 because it is expensive. And now let's take a look at other macro indicators. What is happening in the United States? Please look at this one. This is showing the time span again. 2001 and approximately 25 years. Here we have. Here the scale is $1 trillion. So this is $12 trillion and this is $24 trillion. In the 2000, the United States approximately $14 trillion economy. And now, today, as you see, it is approximately $23 trillion. The chain index, the index value for approximately 2007 numbers, and seasonal adjusted at annual rates. This is showing the GDP growth rate. This is year over year, okay, for each quarter, and this is quarter over quarter, seasonal adjusted average rate of growth. Okay, as you see here, in the third quarter of the 23, year over year is 3.2. Last quarter is 3.2. So the United States growing around 3% in the last two quarters. And trend growth is 2.1%. So if the economy is higher than this trend growth rate, meaning that the economic indicators showing there is a really heating up in the economic indicators. It is inflationary. But if the trend growth rate is 2.1, and if the economy growing less than 2.1, meaning that the economy is cooling. So employment market is deteriorating, the unemployment will increase, and inflation number will decrease as well in the next couple of years if the economy grows less than 2.1%. And let's look at what is the contribution and components of this United States economy, as you see here. In the last quarter, as you see, it is in the first half of the year, the United States overall economy is approximately $30 trillion economy. It is a huge economy. And what is feeding this economy? The consumption contributing approximately $20 trillion, and the government spending making approximately, as you see here, from 2025, approximately $5 trillion coming from the government spending, fiscal policy. And investment is approximately from 25 to 30, let's say 29, approximately $4 trillion is coming from the investment, and let's say $1 trillion coming from the housing. The most dramatic picture is the minus net export, meaning that United States export less than it is important. Okay, so they have a current account deficit and the trade deficit when compared to the rest of the world in the trade indicators. And here, the most important slide, according to my opinion, is a cyclical indicators. This is a big picture and showing what's happening in the economy. Please look at this one first. Here we are. Residential investment as of GDP, meaning that what from which portion of their money the people buying for the residential house. Okay, house investment. Please look at this one. When there's a recession, like here, by the way, this gray bar showing the recession times. Okay, this gray bar showing the recession time. In each recession, here, 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 and here. In each recession, people stop to buy the house, right? Because there is no need to make an investment for the housing market for the current situation. Because my priority changes. I want to live alive, right? And here, when we look at the average of the house market, how much the average growth of the average portion of the housing investment compared to the GDP, it is approximately 4.4. And now it is 4.1. And in the global financial crisis, even it is less than 3%. And in COVID, it is even less than 4%. So residential investment in the part of the GDP is recovery process, right? They have a recovery process when we look at the overall economic indicators from the global financial crisis until today for the 15 years, right? The portion of the residential investment has an upward sloping from approximately 2.5%. They gradually increase their residential investment and reach approximately 5% after the COVID crisis. And let's take a look at business fixed investment. So this is the investment, exactly the investment for the overall economy, not to buy the house, not buy the car. Okay, you are making fixed investment, like you are building up a factory, you are taking a machinery equipment. These are business fixed investment. Okay. And when you look at this quarterly, seasonally adjusted numbers here, as you see, it is around 13% for the overall economy during 60 years. Okay, 60 years, it's around 13%. And business investment is good in the United States right now, even the residential investment as well. And light vehicle sales, okay, please look at it. Again, approximately 50 years and annual rate of change here we have. It is 14.8, meaning 15 million each year. And now it is around the same number. So the economy is recovering. And total business inventory to the sales ratio, it is approximately in how many days your inventory converted to the sales. Okay, this number showing this. This average is 43 days for approximately 40 years average. Okay, 43 days. And now approximately 41, around the average. We are not here, okay, in 53, or we are not here, 35. We are around the average. So economic indicator for the United States is in the recovery process, we can say. And now, as you see, according to National Bureau of Economic Research, we are using some variables to make a decision about whether an economy is in the recession or not. And making recession determination, what indicators we are taking a look at? These are real personal income less transfers, meaning disposable income. Because I have a disposable income, I have overall income, I am decreasing the tax and transfers from that, and it is my disposable income. This is my non-farm payroll employment, household survey employment, real consumer spending, real wholesale and retail sale, and industrial production. These are the basic indicators the National Bureau of Economic Research taking a look at while making decision about whether an economy is in the recession or not. And here, as you see, by the way, the technical definition of the recession is this. If an economy in the 2 consecutive quarters is in a contraction, meaning that minus growth, that economy is in the recession. This is the technical definition of the recession. In 2 consecutive quarters, this quarter and next quarter, if you grow minus, you are in the recession. Okay, 2 consecutive quarters. So what are the indicators I'm taking a look at? This one. So if I take a look at this personal income, non-farm payroll, household survey, real consumer spending, all wholesale and retail sales, and industrial production, all these are in positive region. So there is no technical indicator or earning warning in the United States economy. Okay, no rush, no panic. The economy is not in the recession side. Let's take a look at this one. Developed market equities and growth versus value. These are growth versus value valuation. As you see, we are taking a look at the rest of the world, not the United States. This is Morgan Stanley indexes, world growth, price earning, and standard deviation. Here, as you see, growth stocks, and these are the growth stocks, whether they are cheap or expensive. And as you see here, they are expensive, and below this threshold value, it is 0, they are cheaper. So if I take a look at the current numbers, growth like startups, like the big company. What do you mean by growth? Let me explain it. If you're a company in the San Francisco, let's say, built up 2 years ago with just $10 million capital, and let's say it is in the technology sector, it's a startup, and it is recommendation for the next couple of years is growing sector. But let's say Alibaba, or let's say the Amazon, or Microsoft. Microsoft is a good example, or Volkswagen. These are 50, 60 years company. These are not growing huge. These are value company. We have two categorization in this definition: growth versus value. Okay, growth meaning new, opportunistic, and give an opportunity for you huge, the double, triple, or quadruple earning for the next years. But the Amazon, Tesla, Apple, these are long-term dynamics companies. They have a value in the market. They are growing in small numbers, but they are really, really robust companies. Okay. And here, another picture of the correlation between some different sectors of this US 10-year Treasury yield with the communication, information, consumer staples, utilities, consumer discretionary, real estate, industrials, materials, financials, and energy sectors. Here we have whether an increase in the United States 10-year Treasury yield happen, what will happen to this company? Let's say if the United States 10-year Treasury yield increase, communication services prices decrease, information decrease. But what is increasing? Energy sector, as you see here. Okay. Now we take a look at here the recession determinants, cyclical indicators, and let's look at the consumer side. Consumer spending and saving, because if you have an income, you have two possibilities. You either consume it or save it, right? And the real consumer spending by expenditure category in the United States, let's say, it is year-over-year percentage change, average level of spending. This long light blue one is durable goods, the gray one is non-durable goods, and the dark blue is the services sector. As you see here, in normal times, the economy has higher durable goods, right? Normal times, before the COVID, look at this, normal times, okay? Then, in this, especially the crisis period, like the COVID, because nobody is on the street, you cannot sell the services sector. Nobody going to restaurant, nobody going to the hotels. So services sector is contracting, right? In the normal times, as I say, the durable, non-durable, and services sector. But today, what is bringing the inflation in overall economy, not just in the United States, but the rest of the world as well, is the services sector. As you see, the dynamics is changing. Here, the smallest one is services. Here, the smallest one is services. Here, the smallest one is services. But here, the highest one is services, right? The consumer spending much more money in the services sector when we compare to the durable or non-durable goods. So the portion coming from the income to the sectors is mostly going to the services sector. And the inflation is there, is a little bit sticky prices. Durable goods prices is decreasing, a little bit faster. Non-durable even faster, but the services is not, because there is a building up and inflation inertia in that sector. Inflation inertia in the services sector, bringing this inflation more stubborn in the United States, because most of the income going to the services sector, unlike it is happening in the previous years in the United States. And the personal saving rate here, as you see, average saving rate for the approximately 60 years is 8.5%. But now saving is just this. Why? Because interest rate is a little lower. And people here, as you see, please take a look at this one, especially in global financial crisis before and after it, average consumer saving less. They are more consumption driven economies rather than the investment and saving economy. And what is saving deficit finance? They are borrowing money from the rest of the world, like Europe, like the Middle East, to finance their investment, because United States don't have sufficient saving ratio to finance their investment in their region and territories. They are borrowing the money from the rest of the world because they don't have enough. Here we have the consumer sentiment of the United States. It is an index for the 12 months. It is showing again from 1970s until today, approximately 53 years. And as you see here, we have an average. The most important number is this one, 84. Okay, consumer sentiment. And in the good times, as you see, it is really high. But especially in COVID, here as you see, okay, sharp decrease, and still consumer sentiment in the September 2024, it is just 70, less than the average of the United States 50 years performance, meaning that consumers don't have a coincidence, okay, confidence of their economy in the overall in the United States. And this is the parallel finance, the fiscal policy side, the debt, tax, and revenues of the government. As you see here, $1 trillion. This is the 2024 federal budget, approximately $7 trillion. This is non-defense discretionary defense, approximately $1 trillion going to the defense of the United States. The answer why they are the biggest army and the military power in the world. $1 trillion expenditure just for the military services, higher than the Turkish economy. Overall economy, Turkish economy is just $1 trillion, and the United States is just consuming for their defense industry $1 trillion. Medical care, approximately 1.5 trillion, and social security is $1.4 trillion. And as you see here, the baseline assumption for the overall performance next couple of years, the real GDP growth is approximately 3%. For the next couple of years is less than 2%. This is important. What we say, economy is cooling, unemployment will rise because interest rate decreasing to trigger the economy. 10-year treasury yield, it is 4.5, but gradually for the next 5 years, it will also decrease to the less than 4%, then converge to 4% again. And the headline CPI, consumer price inflation, is currently 3.2, but gradually it will converge to the Federal Reserve target of 2%. Then the unemployment rate, as we say, will rise because of the cooling in the economic indicators. Currently it is 3.8%, but it will gradually increase 4.5% in the next 5 years. And now, the unemployment and the wages in the United States. Unemployment rate for the 50 years average is 6.2%, and it is currently really lower 3.2, even less than half of it. And the wage growth is approximately 4%. And now currently, wage growth here, as you see here, in August performance, higher than the average of the 50 years. It is higher than 3.9% before. And the unemployment rate is really, really low in the United States when we compare to the 50 years average. So employment market is confidential and robust for the United States for now. And inflation, the gray bar, as you see, the recession, these are the headline consumer price inflation, core, CPI, food and energy. And here, these are the deflators for the economy. And this 50 years average is here, July and August here. As you see, in the COVID-19, there is no inflation, inflation is crashing, and the quantitative easing starting, inflation is approximately tripled. And now they started to decrease the inflation. For the Federal Reserve target level, it is around here. It will decrease to this level. Until this, the tight monetary policy stance of the United States will continue. And what brings the inflation in the United States, as you see here, these are really, really important. The sheltering is here, the dark blue one, the highest component, I think, and the auto insurance, the red, and the light blue, dining, recreation, and other services sector is here. And what is making negative contribution, the prices is decreasing, is the orange, core goods, and the energy. They are making negative contribution to the overall inflation in the United States today. So